Hey, hi everyone. Welcome to another video. So today we are going to discuss about random walk theory and efficient market hypothesis. Okay, and how this random walk theory and efficient market hypothesis related to ETFs, which is exchange traded fund. So you must have remembered the video where we discussed about ETF, John Bogle of Vanguard and a power struggle where he took it up merger and that merger failed and the investors basically made him a fund manager. And actually they tried to fire him, but he said he'll wage a proxy war, so they put him as a fund manager. And then he read this book called Random Walk Theory, and it was a power struggle basically. But yeah, and, he was the CEO, who was made a fund manager, and so he was again trying to gain power. Uh, yeah, so he read this book called Random Walk Theory and Efficient Market Hypothesis, and he believed that this is going to the future. He was again a pioneer in entire mutual funds, and he invented the low cost mutual funds. But again, he was the one who drove the ETF revolution also, and that ETF revolution, and it's a trillion-dollar industry now because of this random walk theory and efficient market hypothesis. So we'll talk about this random walk theory, efficient market hypothesis, how ETFs are related to this random walk theory and efficient market hypothesis. Can really fund managers outperform the passive index funds? And is just fund managers' performance an anomaly? Or is it really something that can be done consistently? And does past historical price data, publicly available information, and technical analysis, fundamental analysis, can be used to predict the market? Okay, all this we're going to discuss. And what are the contradictions to this efficient market hypothesis? We'll go through some examples also from US, UK, and India. So that's the topic for today. So random walk theory. So this random walk theory is proposed by Burton Malkiel in his 1973 book, A Random Walk Down Wall Street. So that's a book that's very famous. It's a mathematical, based on a mathematical concept, right? So basically says, future doesn't have any relationship with the past. Okay. So the key idea is basically is price movements are completely random. It doesn't have any relationship. At the same time, it's random also. Okay. So price movements are completely random and unpredictable. Okay. So these two things you remember. The future price movements are completely random and unpredictable. Okay. So that's the first thing. And past trends or patterns have no bearing on future prices. Okay. So that's a key assumption of this particular random walk theory. The price moves in like a random walk, like a drunkard doing a random walk, okay, down the street. Price also does a random walk on Wall Street. Okay, so that's a key idea. So that price is movements for future price movements are completely random and unpredictable, and past trends or patterns have no bearing on future prices, which is yeah. If you ask a physicist, they may not agree with this. That if time is another dimension, as per Einstein's relativity theory, you can travel past and to the future, and as per it, time is already fixed, and past price moment, everything is fixed. But that, yeah, that's all philosophical and physics. But let's come to this theory. Okay, so even technical analysis, what we do, or even in the AI algos which we are using, like LSTM, long short-term memory models, or the CNN models. Most of the models basically look at the historical price data and try to predict the future. And this theory basically contradicts that. So its primary assumption is saying that future is has got nothing to do with past. There is a saying, history repeats itself, but it contradicts that, saying that future has got nothing to do with the past, and all these past trends patterns have nothing, no bearing on the future prices, and it's all future price movements are completely random and unpredictable. Okay, even though this randomness is not there. Okay, all there is a pattern even in randomness and unpredictability. There is a structure. Okay, so that's what normal distribution is, right? Even if you throw balls randomly and unpredictably, they do fall into a structure. Okay. uh, but yeah, that's what this theory is. This theory basically says that future price movements are completely random and unpredictable, and past doesn't have any bearing on future. Okay, that you remember. And it also says that all available information is already priced in. So the price, stock price, reflects all the available information in the market or in the world. And any attempt to time the market is futile. Okay, so that's what it says. Past is independent. The future future price movement is independent of past, and it's completely random and unpredictable. And price already has all the information, factored into it. So it's not possible to time the market, and that attempt to do that is futile. That's what it says. Whereas efficient market hypothesis, this is developed by Union Pharma in the 60s. What this says is all available information, past historical price data, public information, which are annual reports, all these meetings, all that public information, and private, which is insider information, also is immediately fully reflected in the current stock prices. The stock prices basically have all this information already factored in. The past, public, and the private information is what the efficient market hypothesis says. There are different types of efficiencies. Weak efficiency says past prices and volume information is already priced into the stock price. So technical analysis is basically ineffective. That's what it says. In a weak form of efficiency, semi-strong form of efficiency, all public news, info, news, earnings, etc., are also factored into the price. And fundamental analysis is ineffective, is what this says. Strong efficient market hypothesis says all info, public, private, everything, even private means insider information, also is factored into the prices, and no one can beat the market, not even insiders can beat the market, is what this strong efficient market hypothesis says. So that's a theory, the efficient market hypothesis and random walk theory. So how these are related to ETFs? This EMH, which stands for efficient market hypothesis, and random walk theory, these support passive investing. So when you can't time the market and that effort is futile, and all technical analysis, fundamental analysis, all futile, then just go with the market. That's what it says. That's what supports passive investing, and they simply say that it's nearly impossible to consistently outperform the market. And benchmarks like Nifty 50, S&P 500, FTSE 100, you can't consistently outperform them. That's what this theory says. And ETFs have risen from this passive investing, and they are low cost index tracking vehicles, and designed to not beat the market but to mirror the market. Okay. And this philosophy of EMT and RW2, passive investing, and low index cost index tracking, uh, you know, has basically given rise to Vanguard, SPY, iShares, Nifty Bs, etc. ETF, entire big ETF industry got born out of it. Yeah, the question comes is now, can fund managers outperform ETFs? Yes, some can, but it's rare and inconsistent, is what this theory says. EMH says if markets are efficient, any consistent outperformance is just luck. Okay, it's not skill. But the reality is different. This theory says it's luck, but reality is fund managers like Warren Buffett, Peter Lynch, Rakesh Jhunjhunwala, a lot of hedge fund managers we went through in the hedge fund series have outperformed the market many times. Okay, they did it for decades also, suggesting that inefficiencies do exist. Okay, and yeah, but average mutual fund manager, his record is dismal, and yeah, that is true. But some people can outperform due to the skill, not just chance. That Eugene Farmer himself has confirmed that. Okay, and how EMH classifies information, historical prices is already priced in. So in the stock price, so no edge will be there via charts. The technical analysis is useless in weak form. Fundamentals like ROE, PE are already priced in quickly, so no edge in semi-strong form. Insider information is already priced in strong form. News and announcements also, market reacts instantly and no time to profit consistently. Okay. Contradictions and real world violations of EMA. So that's the theory, and that's what the ETF industry came out of it, and the reality is also a little bit different for few people. There are some contradictions to this efficient market hypothesis. It's a theory and it's not bulletproof. There are behavioral biases. So people are driven by, or markets are driven by fear, greed, and herd behavior. And the examples are dot-com bubble, 2008 crash, 2020, one meme stock rally, GameStop, AMC, all these defy EMH. So, okay. Um, Whenever there is some, big event, EMH doesn't work basically. Okay, and because then fear, greed, herd behavior kicks in, behavioral biases kick in. Technical and quant analysis, yeah, many tech firms or quant firms, Renaissance, D Shaw, they do find patterns and inefficiency, and they've made a lot of money also. Renaissance makes 68%. Okay, so as per EMH, it's not possible to beat the market, but they have bet the market consistently by using some quant strategies. Yeah, and if you see the record, momentum strategies, mean reversion strategies, RSI divergence strategies have shown predictive power. Okay, so predictive power is future prediction. It's not, everything is prediction. We even our technical analysis, price action, everything we predict, and there's a probability to it. But yeah, these have more predictive power, contradicting EMH. So you can predict the market, and these have consistently predicted the market, contradicting efficient market hypothesis. Fundamental dislocations also, stocks like Tesla, Zomato move widely despite known information, challenging semi-strong form. So fundamentally, also, not only technical analysis, by using technical analysis, some funds have outperformed, the index, and using some strategies like momentum, mean reversion, and RSI divergence, which are all technical strategies. The funds have outperformed. Fundamentally, also some funds have outperformed because they see that the future is bright for these like Tesla and Zomato. Okay, okay. Real world examples: ARK Investment, Kathy Wood. She has bet the market in 2020 using tech future trend bets, but she underperformed in 2022. Performance is cyclical and not permanent. Berkshire Hathaway has consistently outperformed using fundamental analysis only. This shows markets are not fully efficient. In UK, also Fundsmith Equity Fund bet FTSE over 10 plus years, proving inefficiencies exist in semi-strong form, which is fundamental analysis, can be used to make more profits than the index. Brexit related mispricings also, currency and bank stocks post Brexit, EMH failed to price and sentiment shocks. India also, if you see examples, so US we have Berkshire Hathaway, ARK Invest Fund, in UK Fundsmith and Brexit. India we have mid cap and small cap rallies. Last 2 years, this is what's happening. A lot of mid cap and small cap rallies. This is driven by FII inflows, not fundamentals. But yeah, so that has also, you know uh, basically failed the EMH theory. Adani Group stock surges and crashes also. Price moved much faster than the public information flow, news flow, violating EMH. Retail traders using RSI super trend on zero the kite still find repeated success, not explained by EMH. Okay, so people using RSI are able to find success, which EMH can't explain. EMH means basically all this technical fundamental analysis is all useless. Even insider information is useless in some markets, and just follow the index. Don't do any, fund management. Is what it says, and these are all the anomalies to it. Uh, like Berkshire Hathaway has used fundamental analysis to beat the market. ARK Invest uses sectorial bet to future bets to beat the market, and Fundsmith has consistently performed 10 plus years. Mid cap, small cap rallies have, nullified this EMH theory. RSI super trend, technical analysis also. All quant firms use technical analysis only, and mathematics, and they have bet the market consistently. Okay. So reality check, random walk theory, partially true. It's only true in ultra liquid and low volatility periods. Okay. Efficient market hypothesis holds for large caps only, but often fails in small and mid caps and even crisis situations also. And fund managers outperforming, possible. Only few people do, but not everyone. It's rare and often inconsistent. ETFs are ideal for average investors, low cost and market matching returns if you want. Okay, this entire ETF came from this random walk and EMT theory, and by one person called John Bogle of Vanguard. Okay, and technical and fundamental analysis, it's still efficient in, some pockets of the market, and you can make good generate good returns. So that's the random walk theory and efficient markets for you guys for today. And that's it for today. Thanks everyone for having a nice and have a nice day. Bye.